Hi guys, it's Tara Krieg for this week's Wisdom Wednesday. Holy Toledo, the bond market has just taken an absolute beating on Friday and today. So on Friday, we got the CPI numbers, which is the Consumer Price Index, and inflation actually ticked up even a little bit more. So we're at 8.6%. The Fed's target rate is 2%. Clearly, the efforts that they've made up until this point have not been significant enough to stop inflation. And what needs to happen? Interest rates are going to have to continue to rise until they start to see inflation come down. So we fully expect that with the Fed meeting that's happening in June, they had originally projected 0.5% as a rate hike, but I wouldn't be surprised at all to see 0.75, maybe even 1% aggressively to show that they are committed to getting this inflation issue under control. So I want to share some basic numbers with you guys to help you better understand how rising interest rates have affected the buyer's buying and in turn, why we're seeing an uptick in inventory and why buyers are getting discouraged. So in January, with rates in the low threes, for a $3,500 principal and interest payment, a buyer could afford about $807,000. Fast forward to April. In April, that same buyer, for the same monthly payment of $3,500, could only afford about $643,000. Fast forward to June, only 1 month later, the rate went from 5.1 to 6.25, and their buying power went from $643,000 to $568,000. The lost buying power from January to June is over $238,000 in purchase price or buying power for that buyer to have the exact same monthly payment. Now, what this doesn't take into consideration, guys, is the appreciation that we had seen from January 1st until the end of May because of the buyer frenzy to get locked in as interest rates were making that climb. I know this is going to sound crazy, but that home that was listed at 807, assuming a 20% appreciation, is now over 900,000. And that buyer buying today is now only qualified at $568,000. That's over $400,000 in lost buying power. So the challenge, the affordability gap is real, you guys, for these prospective buyers. I had a well-qualified couple come and meet with me last week. They're renting and they want to buy. And they thought, okay, based on purchasing a home that would meet our needs, we were looking about $600,000, and they were comfortable with an all-in monthly payment up to about $3,200. After going through a payment scenario with them, realistically, they're looking at a purchase price or buying power for a $3,200 payment of only about $475. There's the gap, guys. $600,000 is really what it's going to cost to get them into something that would meet their needs. But for the $3,200 payment they're comfortable with, they're shopping at $475. So what's going to happen in that gap? Well, we're going to have to watch the inventory and home prices. We're already starting to see price reductions, and so we need to do a good job educating our buyers. We've got a fabulous 2-1 buy down strategy that we can use with buyers who need to baby step into that payment. And if you want to learn more about that, please feel free to reach out to me. But the seller, through a seller concession, can pay for that not permanent rate buy down, because again, if our interest rates drop back down, they don't want to spend all this money now and then they never break even on that upfront cost. But if we do a temporary buy down, they get all that savings in the first 24 months of owning the home. And if rates do go down and they want to refinance down the road, they haven't thrown a bunch of money away. So if you guys have any questions or concerns, please feel free to reach out to me. Otherwise, every Wednesday, we'll continue to provide you market updates on what we're seeing on the lending side. We hope you guys have a great week.